We don't think it'll be appropriate to reduce rates and begin to loosen policy until we have more confidence that inflation is moving back down to 2% on a sustainable basis. And that's the test we've applied. We see today's report as progress and as building confidence, but we don't see ourselves as having the confidence that would warrant beginning to loosen policy at this time.
Comments there yesterday from the Fed Chair Jay Powell, who poured some cold water on the idea that more rate cuts than previously thought could be coming in the U.S. this year. But now that the dust has settled a bit after a busy Wednesday, it does seem clear the market has placed greater weight on yesterday's consumer price report in the U.S. than the Fed announcement. I say that because stocks and bonds have retained a good portion of their post-CPI rally, even after the Fed's so-called dot plot projected just one rate cut by the Fed this year. And then over the last hour, we got some U.S. producer prices adding to evidence that inflationary pressures are easing. For more on how investors should be assessing the situation, we're joined by Tim Urbanowicz, Head of Research and Investment Strategy at Innovator Capital Management. Tim, it's nice to have you back with us. It does feel to me like we have two camps, the Fed and what they see in front of them and what they are telling us, and the people who are listening to the Fed and painting their own picture of what happens ahead. What do you make of the situation?
Yeah, John, yesterday was interesting. You really had two very different scenarios playing out. You had the market that really wants the Fed to be in a rush to cut rates, and then Powell coming out in the press conference and really just reiterating the fact that they're going to be patient. And I think from an investment perspective right now, really the next few months are going to continue to be just driven by this immaculate disinflation narrative. It's going to be a very good time to be in the equity market. You have to be in. We're encouraging our clients to stay in right now. The pause has always been a profitable experience for investors, longer term or shorter term. So you have to be in the market right now, regardless of what that picture looks like 4, 5, 6 months out.
And just to be clear, are you expecting any Fed rate cuts in 2024?
We are not. And that's really been our call all year long, John, even when the market was pricing in 6 rate cuts earlier, just for the simple fact that I think that the consequences of inflation far outweigh the consequences of making a mistake on the other side and leaving rates too high for too long. Yeah, you listened to the interview last week with Minneapolis Fed President Neel Kashkari. I think he hit the nail on the head. He said, the majority of Americans would rather see a recession than continue to deal with prices moving higher. And I think that's going to be the Fed's mindset moving forward. I think the good news for investors, even if we are in this higher rate environment, it's still an environment where stocks can do well. The risk that we need to be paying attention to 4, 5, 6 months out is really what the landing looks like. But right now, it's all about staying in the equity market.
So 2 things you've said. One is you don't think the Fed's going to cut interest rates this year. And number 2, you think the stock market can keep on climbing.
That's right, John. And I think if you just look back over the last couple of years and you look at how the market has fared, I think a lot of it has to do with the concentration that we see at the top of the index in these mega cap tech stocks, specifically the Magnificent Seven. That subset of stocks is up over 75% since the Fed began this hike cycle. So clearly that is a pocket of the market that can handle higher rates. I think where you need to be more cautious is in rate-sensitive areas of the market, specifically small caps. This hasn't been an area that has done well. They're much more sensitive to rising rates. That said, we see the spring is very compressed in those names for a time when you do see rates really start to come down if we see the soft landing play out. Now, again, I think we're several months out from that, but certainly something to be thinking about for the remainder of the year.
I'm going to shift away from the idea of the Magnificent Seven and just create a new bumper sticker here, the Triumphant Three, because Bloomberg had a stat this morning suggesting Apple, Microsoft, NVIDIA, like that is upwards of a third of the S&P 500, which at last count was several hundred companies, not 3 companies. But you're saying that technology's dominance is something you wouldn't be betting against right now. I
wouldn't be betting against it. And, really, John, it's all about they have significant cash flows. They have significant cash flows right now, which really reduces that sensitivity on interest rates. You know, I was just with a group of advisors down in Atlanta this last week. You know, a lot of their clients are getting nervous with just how much these stocks have run up. And our message continues to be, you got to be in. The pause is a profitable time. We continue to see investors gravitating to the ETF market toward the structured product, buffer type strategies like AAPR, where they have 100% downside protection, but they still have exposure to the S&P up to an 18% cap over 2 years. Great way to stay invested in those stocks, even when you might be getting nervous with the market at all-time highs, even when we might be getting nervous as to what this outcome might look like. Really, really important right now.
And then what does history tell you about when there's plenty to worry about, but the market keeps chugging along for whatever reasons that are pushing the market along? When you go back in history and look at a market that is constantly making record highs, what have you learned about what happens, let's say, if you're looking out, call it a year?
John, I think the main point is an all-time high is not a catalyst for a sell-off. I think a lot of investors think that it is, but it's really not. And in fact, typically when we see the market at new highs, it generally tends to be a very good time to be invested. And why that's so important right now, too, is you look historically, those all-time highs, they come in bunches. You know, the stretch from 1989 to 2000, we saw the market hit a new all-time high every 9 trading days. From 2013 to 2022, we saw a new high every 8 trading days. We're seeing a similar pattern now. You have multiple new all-time highs that are being hit. You have to be in the market at this time. And the main point, not only is an all-time high not a catalyst for a sell-off, it's generally a pretty profitable time to be in equities, so you got to be in.
Okay,